People see headline like Wall Street Panic, and they imagine one man in Ottawa making one decision, and suddenly New York start to cough. Nice movie, but real story more subtle, and in some ways more frightening. This not Mark Carney versus Donald Trump as personality contest. This is North America discovering it built one deeply integrated credit system across a border, and when politics turns volatile, that system starts to seize. Carney matters here because he speaks fluent balance sheet. He is former central banker, long time inside global finance, now prime minister. So his words land differently with bankers and pension boards. In 2025, he has been framing Canada-US relationship as entering colder phase, saying era of ever tighter integration is over, and pushing Canada to diversify partners. In week of December 18, 2025, he publicly played down chance of quick sector-by-sector tariff deals and pointed instead to the coming review of the North American Trade Pact, the USMCA. On December 22, 2025, his office announced a new ambassador designate to Washington, Mark Wiseman, with mandate focused on tariffs, border issues, and trade and investment ties, and Ottawa confirmed formal review talks are set to launch in mid-January 2026. So yes, Carney is treating this as serious strategic relationship shift. Now, here is where internet commentary gets dangerous. Some people talk as if Carney can simply order Canadian billions to leave US markets and crash America overnight. Banking not work like tank division. Canadian banks and pension funds have fiduciary duty, meaning legal duty to protect returns, and they do not burn their own profits just to make geopolitical point. But do not dismiss the stress either, because the leverage is structural, not theatrical. Canadian capital is woven into US credit and US assets, and US risk is woven back into Canadian balance sheets. Bank of Canada research on the Big Six banks shows roughly half of their assets are outside Canada, and US dollar dominates those foreign exposures. In plain language, that means Canadian banking system is not local anymore. It is continental and global, so any repricing of America feeds straight into Canadian risk models. Here is the mechanism that matters. In finance, liquidity just means how easy it is to get cash or credit without selling something at terrible price. In modern America, huge chunk of economy lives on rolling credit, not paying it off. Commercial real estate loans, corporate credit lines, and many investment projects come due and then get refinanced, rolled into new loan. If lenders decide risk has risen, they do not need press conference. They tighten standards, shorten maturities, and demand more collateral. Use one simple picture and keep it in mind. It is tall bridge between two cities. For years, traffic flowed fast, both sides built businesses, assuming bridge always open and cheap. Then politics turns and someone raises tolls and adds inspections. Bridge still open, no dramatic closure, but slowdown itself becomes economic event. Credit is that bridge. When risk committees add inspection and toll, projects that were barely profitable stop, and markets that were living on constant refinancing start to look fragile. One reason this story resonates is because Canadian institutions really did become major players south of border over last 2 decades. After 2008 crash, US regional banking shrank and consolidated, and big Canadian banks expanded their US footprints, buying franchises, building branch networks, and becoming large lenders to households and to mid-sized companies. They are not exotic outsiders, they sit inside core credit infrastructure. So when a Canadian bank decides to de-risk, it can show up in Florida mortgage desks, in Midwest commercial loans, in New York office refinancing, even if nobody says the word Canada. And when someone online says they pulled billions, what that often means in practice is boring sequence. They stop growing certain loan books, they sell some US securities, they reduce warehouse lines to lenders, they demand higher down payments, and they choose not to roll over marginal loans. Each step looks small, but together they change availability of credit. That is the tightening people feel, even if no politician announces it. Recent financial stability analysis in Canada has noted signs some investors have been rebalancing exposure away from US assets as trade policy disruptions ripple through markets. If that trend grows, US needs to pay higher risk premium to attract money, and that is how panic becomes higher yields, tighter mortgages, and weaker growth. Now connect this to the part everybody feels. When liquidity tightens, small business lines of credit shrink, developers cancel projects, refinancing fails, layoffs follow, and then local tax base weakens. So cities cut services. Many households leave one unexpected expense away from trouble. So mild credit contraction can feel like recession. Meanwhile, political leaders argue about flags and slogans, but bank risk committees argue about covenants, loan-to-value, and duration. That is real power in this system. And it is also why the story is not Canada attacks America or Carney humiliates Trump. It is a repricing of risk inside a tightly coupled market, with politics acting as trigger for a sudden reassessment of risk. If Canadian banks tighten in US, they often tighten at home too, because losses and uncertainty travel back through same financial channels. Canada cannot discipline US without catching shrapnel, and US cannot bully Canada without damaging its own supply chains, energy inputs, and critical minerals pipeline. Notice also what regulators are telling you between lines. In mid-December 2025, Canada's banking supervisor kept its domestic stability buffer at a higher level and pointed to elevated but stable vulnerabilities like household debt and softer corporate credit quality. Translation: system is resilient, but they want big banks to keep extra cushion, which usually means slower balance sheet growth and more selectivity in lending. That is not panic, but it does mean credit expansion runs with tighter tolerances. And when political shocks hit, tolerances matter. So the fantasy of a clean, surgical financial strike is mostly propaganda. What is real is feedback loop. Tariffs and policy unpredictability raise risk premium. Higher risk premium raises borrowing costs. Higher costs increase defaults. Defaults validate fear, and then lending gets even tighter. In that loop, Canadian institutions are not puppets of Prime Minister. They are actors responding to incentives and regulations. They are regulated heavily in Canada, and their US subsidiaries are also under US supervision. So they move through committee decisions and models, not like Prime Minister issuing single command. This is where Trump's style collides with financial reality. You can threaten tariffs, you can threaten reviews, you can posture about sovereignty, but you cannot force a lender, especially foreign-controlled lender, to renew a loan if spreadsheet says risk-adjusted return is bad. That is why real estate-heavy economies and real estate-heavy politicians hate credit tightening, because it is relentless and does not care about your rhetoric. So what should you watch if you want signal, not noise? Watch refinancing calendar in US commercial real estate and leveraged corporate debt, because that is where rollover risk turns into crisis. Watch credit spreads and lending standard surveys, because those move before unemployment does. Watch whether large foreign institutions keep buying US assets at same pace, or diversify more aggressively into Europe and Asia, because that shift raises cost of money in America. And watch diplomacy calendar too. If mid-January 2026 USMCA talks turn into public political conflict rather than technical work, that is how you feed uncertainty back into markets. The formal joint review window starts July 1st, 2026, so markets will price that uncertainty early. Now for tough question nobody wants to say out loud. Who benefits from keeping public focused on personalities while financial dependency remains untouched? If America says sovereignty but finances itself like debtor, dependent on steady foreign confidence, what sovereignty actually means? You cannot tweet your way out of funding problem, and you cannot tariff your way into cheap credit. If Washington wanted true independence, it would accept higher domestic costs, more disciplined budgets, and less asset inflation built on cheap debt. And that is political poison, so leaders pretend there is painless path. My judgment is this: danger is not one speech in Ottawa. Danger is slow tightening that turns into sudden snap when too many loans come due at once in an environment where politics makes risk hard to price. Carney may be early messenger, not puppet master. If you want one indicator to hold in head, it is moment refinancing windows start closing in bulk. When that happens, what looked solid becomes fragile in weeks, and fight you thought was about two men becomes about millions of families trying to keep roof and payroll.